Hey everybody, Scott Dyreng here. Happy to be with you today on Fuqua's Wednesday at 12:30 LinkedIn Live sessions. It's a great privilege for me to be able to talk to you today about my favorite topic, which is probably your least favorite topic, taxes. Today we're going to talk a little bit about the proposals, some of the proposals that the Biden administration has made relating to tax changes. And as we go through some of these proposals, I suspect that you might have questions. And those questions will be something I'll try to answer. So if you have a question, I strongly encourage you to put those questions in the comments section, and I will try to address them as we go along. The first thing that I want to talk about, well, let me first caveat this by saying there are many proposals that have been made by the Biden administration. And the ones that I will focus on today relate specifically to corporate taxation. And I'm focusing on those because I have more expertise in that area. But if you have other comments related to the non-corporate tax proposals, I'd be happy to try to address those if you write those questions in the comments. The first proposal that the Biden administration has made, it relates to raising the corporate rate, the statutory tax rate for corporations from 21% to 28%. So you might recall that for many years, the corporate tax rate was 35%. If you go way back to the last major tax reform we had in 1986, the corporate tax rate was set at 34%, and it stayed at 34% until the Clinton administration, at which time it was raised to 35%. And from 35%, it stayed constant until the end of 2017, when the Trump tax reforms, the Tax Cuts and Jobs Act, lowered the rate to 21%. And one of the major campaign promises in the presidential cycle, the election, was that the Biden administration would seek to raise that rate from 21% to 28%. So in thinking about effective tax rates, or statutory tax rates, we should also think about effective tax rates, because the rate that a company pays is not necessarily the rate that is on the books as the law. And if you have followed the news, you often see articles about companies that make and report high profits, but also pay very little in tax. In 2016, the year before the Trump Tax Act, the average US company had an effective tax rate of about 26%. The effective tax rate being the amount of cash taxes that the company paid divided by the amount of pre-tax accounting earnings the company reported to shareholders. When the tax rate was reduced from 35% to 21%, that effective rate dropped from 26% in 2016 to about 22% in 2019, which is the most recent year that we have complete data on. The preliminary data for 2020 suggests that the rate will be probably about the same, around 22 or 23%. If the rate were raised from 21% to 28%, a few things would likely happen. The first thing is effective rates would likely increase. So companies would, instead of reporting, say, a 22% effective rate, it's likely that that rate would go up. Would it go up all the way to 28%? Probably not. Companies rarely pay exactly the statutory tax rate, and on average, they will find ways to reduce their income for tax purposes, and will probably pay a rate lower than 28% if that is the statutory tax rate. Nevertheless, raising the rate will likely raise some revenue, and if the objective of the administration is to raise more revenue from companies, from corporations, then raising the rate to 28% would accomplish that goal. What are the trade-offs? if the government raises the rate to 28% or something higher, or whatever it is, the higher the rate goes, the greater the incentives for companies to engage in strategic tax avoidance activities. Those activities often involve transferring intellectual property to tax haven countries like Cayman Islands or the Virgin Islands or Ireland or others. And those strategic tax avoidance activities can have distortionary effects on investment, on research, on employment, and other things. And so we always face a trade-off whenever we tax a company. Every tax creates some kinds of economic distortions, and those distortions reduce good things that companies do. My suspicion is raising the rate to 28% will increase some of those distortions, but probably not to an extraordinary level. The other thing that we should think about a little bit with a higher rate is that companies historically have engaged in something known as inversions. And an inversion is where a company changes its location, its legal incorporation location from the United States to a foreign country. It does this essentially to avoid paying tax in the United States in a way that it would if it were an American company. Sometimes these inversions are called expatriations or other names. When the US rate is at 21% and essentially equal to, or maybe even slightly lower than other developed countries, US firms have very little incentive to try to relocate to other countries. But when the rate is higher than other developed countries, US firms might have an incentive to relocate, and new firms from entrepreneurial activity might be tempted to form at inception in locations outside the United States. So those are a few things that one might consider when thinking about raising the rate from 21% to 28%. As we go along, feel free to ask any questions related to rates, and I'm happy to give my opinion. The next issue that the Biden administration is considering is to implement what they are terming a minimum global tax. One of the issues that has been prominent in the press related to tax avoidance is that large US multinational companies, and particularly those companies with heavy intellectual property presence, can move that intellectual property to really any location in the world. And as a result, much of that intellectual property is located in foreign jurisdictions with low tax rates. And it's becoming increasingly difficult to tax those companies with a lot of intellectual property. The Trump administration recognized in the Tax Cuts and Jobs Act that when the rate was lowered there and the system was changed in the way that it was changed with the Tax Cuts and Jobs Act, companies might increase the amount of earnings recorded in low tax foreign countries. And so a new tax rule was created that goes by the acronym GILTI, G-I-L-T-I, which stands for Global Intangible Low Tax Income, GILTI. And GILTI income is foreign earnings earned in a foreign country that the US taxes. And the US tax rate on those foreign earnings is sort of low. It's like 11%. So companies still have an incentive to recognize earnings in foreign countries because 11% is lower than 21%. The Biden administration is proposing a change, several significant changes to the GILTI tax regime. The first change is that they want to raise the rate on GILTI income from essentially 11 or 12% up to about 21%. That's a pretty big change, and it would certainly cause many companies to pay more US tax on their foreign earnings. The second change is that under the current GILTI rules, A company does not have to pay tax on GILTI income for any income that is earned below 10% return on foreign assets. So in other words, you only pay GILTI tax on earnings where the return on assets is quite high. The Biden proposal would remove that exemption for earnings below the 10% return on assets threshold. And the third change is that this GILTI tax would be calculated on a country-by-country basis, as opposed to pooling across countries the different earnings and losses and so forth. This last measure could be quite, I would say, substantial in terms of changing the tax on foreign earnings, because it could result in situations where multinational companies end up paying taxes to the US, even though overall abroad their consolidated earnings are low or even negative. So this will be a significant change. If this change happens, it could require the cooperation of other countries and to make it work well. And Janet Yellen has signaled a willingness to cooperate with other countries. And to the extent that that happens, this could be a really meaningful change in the way companies are taxed on their global income, US companies taxed on their global income. The third major area of reform is related to what I would has been termed a 15% minimum tax on financial accounting income. Now, this is essentially a rule which is being proposed in response to several high-profile situations where well-known companies reported very large profits to shareholders in their financial reports, but paid little or no tax to the federal government. Maybe the most famous example is, I think 2 years ago, Amazon reported $11 billion in pre-tax income and paid no federal tax. More recently, we've seen companies like, for example, Salesforce reported $2.6 billion of US income and paid no federal income tax. And there was a recent article about Zoom, the company that we have all grown to love or hate, also recording significant profits and paying very little federal tax. What this proposal is designed to do is to prevent any company that records large financial accounting profits from paying no tax. This is almost unambiguously, from an accounting point of view, and I am an accountant, this is a bad idea. And the reason that this idea is a bad idea is let me explain to you, I guess I should say, why this is a bad idea. The tax system is created to achieve several different purposes. One of those purposes is to raise revenue. Another purpose is to encourage or discourage certain types of behavior. So, for example, we might impose a tax on cigarettes because we think that smoking is bad for your health. Or we might provide a tax credit for a firm that invests in renewable energies. And those types of provisions are designed to encourage behavior, not to raise revenue. A third reason that or objective of the tax code is that we often attempt to achieve social objectives, such as redistribution of income or wealth. In contrast, the financial accounting rules under generally accepted accounting principles in the United States have an entirely different purpose. The purpose is generally to provide information to investors to aid them in the efficient allocation of their scarce resources, to provide an economic picture of the company, and to guide those types of investment decisions. You can imagine if taxes are suddenly imposed on financial accounting earnings, that a couple of things could quickly arise. First, companies might be tempted to alter the way that they account for earnings to reduce their tax bills. This might have an unintended side effect of reducing the value of the information in those reports that will make them less reliable to investors. The second and more concerning issue is that if the tax revenue is suddenly tied to financial accounting income, it will be very difficult for our elected leaders who set tax policy to constrain themselves from also trying to meddle in financial accounting rules. And in fact, a few years ago, during, I guess, a year and a half ago or so, during the presidential cycle, in the campaigns, Senator Warren, who was running for president, made a proposal similar to this one that the Biden administration has now proposed. And I wrote an op-ed, which is published in the Wall Street Journal, essentially opposing this proposal on the grounds that financial accounting information could become subjected to the desires of politicians. Shortly after, several months later, a letter was written to the Financial Accounting Standards Board by Elizabeth Warren and several other senators requesting that a certain financial accounting standard be adopted to aid in tax enforcement. This is exactly the type of thing we don't want our politicians doing. We need financial accounting rules to be apolitical, and taxing financial accounting earnings will almost immediately create a situation where financial accounting becomes another political tool. So for many reasons, taxing financial accounting earnings is probably not a great idea. And one of those reasons is trying to keep the politicians from politicizing financial accounting rules. I have a question that's come in that asks whether large earnings are untaxed because of previous year losses, and whether or not it makes sense to then use financial accounting earnings. So in other words, how could Amazon possibly earn 11 billion and pay zero tax? That's a really good question. And actually, there's a very simple explanation. And this explanation is true for Amazon. It's also true for Salesforce. And it's also true for Zoom. Amazon in 2018 recorded 11.4 billion, if I recall correctly, in profits. Amazon and many other tech firms, they pay their employees, at least in part, using share-based compensation. And in the case of Amazon, it's restricted stock units. When an employee is hired at Amazon, Amazon might grant to an employee a restricted share. And when that share is granted, the financial accounting rules require that Amazon record a compensation expense in its financial reports based on the fair value of the restricted stock unit, which is the price of the share on the date that it was granted. So if Amazon's stock price 5 years ago was, say, for example, in fact, I think I looked this up. I think 5 years ago, Amazon's price was $620 per share. If a company was hired 5 years ago by Amazon, Amazon would give a restricted unit and record a compensation expense of $620. The IRS, however, does not allow Amazon to take a compensation tax deduction because the employee doesn't yet control that share. And in fact, the employee might leave and never control the share. And so Amazon would never even really give the share before it vests and it would not make sense to give a deduction for something that hasn't yet been realized. Instead, what the IRS says is when the restricted stock unit vests and the employee then has control of it, then Amazon can take a deduction for that share that is given away, and the deduction will be equal to the fair value of that share on the date of vesting. And this makes sense because the employee will pay tax on personal income tax on the value of the share that is received on the date of vesting. In Amazon's case, suppose the share vested 5 years after it was given. So it was given at a price of $6.20, but 5 years later, today, when it vests, Amazon's price is $3,308. The employee would have to pay tax on the $3,308 just like they had been paid in cash, and Amazon will receive a deduction for $3,308 just like they had paid the employee in cash. Everything seems fine there. But what's interesting is financial accounting does not require an additional compensation expense because the share price increased. As a result, when Amazon reports its income, it does not record the difference of $2,800 in compensation expense on the financial statements, which makes it look like it has really high financial accounting income. But for tax purposes, it gets a really big deduction. So when all the dust settled for Amazon, it had 11.2 billion of restricted stock units that vested, and it had 11.4 billion of income. And that meant that its deductions essentially offset all of its income, and it didn't pay any tax. It really turns out that it's more of a financial accounting problem in that case, not a tax problem. Another question, what traction do you think the administration will have about setting a global minimum tax rate for corporations? Would this change require a critical mass of countries to have its intended impact? This is a really good question, and I think a really big issue. If a global minimum tax is to be successfully implemented, I believe it will require cooperation with many, if not most, countries. 2 years ago, if you would have asked me if this was conceivable, I would have said no. The countries are very unlikely to cooperate in a way that is meaningful. But given the change in the global landscape and the way that the countries in the OECD are cooperating, and Secretary Yellen's indication that the Biden administration is willing to also cooperate, I think the probability is higher. I think it's not super high, but I do think it's higher. If all of the countries in the world cooperated, a global minimum tax might be an effective tool for reducing certain types of tax strategies that involve income shifting. But it will require a pretty high degree of cooperation. And one example of this might be something like the following. In the United States, each of the 50 states can set its own tax policies at the state level. And there is significant income shifting and tax avoidance across states to reduce state tax burdens, because even within the United States, the 50 states do not cooperate, which creates disparity in the law across states and opportunities for companies to exploit that disparity. So there's a part of me that says, if even within the United States, the various states cannot cooperate, it seems even less likely that across the world, different countries will cooperate to a degree that is necessary to really rein in income shifting. I hope I'm wrong, but I might be. My experience says it's going to be difficult, a difficult challenge to overcome. Okay, I believe that addresses most of the questions that have been asked. Very good questions. And that, I think, also covers the majority of the corporate tax reform plans that the Biden administration has proposed. Obviously, there's much more to talk about, and the details are not even really known yet. So as those details become available, things might change. But overall, I believe that there is going to be a lot of interesting change happening in the corporate tax landscape that could significantly affect the way companies do business in the United States and around the world, really. That's all I have for today. I do want to remind you that this LinkedIn Live series is a weekly series that takes place at 12:30 on Wednesdays. And the next speaker is Carl Mela, one of our great faculty here at Fuqua, and I think he will have something very interesting to talk to you about. So I look forward to hearing him, and I thank you for your participation today. Thank you very much.